everyone, good evening. Welcome to a brand new edition of The Money Show, albeit a truncated one. Results really dominating the show today, but nevertheless, we are here 5:30 p.m. on the clock for today. Now, today's show is a very interesting one. We are going to talk about one particular product that has been brought to you by the government. Well, not exactly by the government, but in a way, yes, because essentially the government, in an effort to raise money from the market, has decided to club some PSUs together and offer it to you, our investors, for sale. The CPSE ETF in its 6th tranche, or you could call it the 6th edition, opens tomorrow. Now, what we are going to discuss today is, should you be considering buying the CPSE ETF? Are there indeed any sort of tax benefits that are available? And of course, finally, would it just be better to buy individual stocks as opposed to this ETF? All of these questions will be answered. And of course, you can, as always, get your portfolio questions and queries answered by our personal finance expert, who we will be introducing very shortly. But before that, here are the big headlines at this hour. The Cabinet clears amendments to the Insolvency and Bankruptcy Code, extending resolution process to 330 days. The government also looks to enforce the rights of financial creditors who have not voted in favor of a rescue plan, as well as that of operational creditors. It's a steady quarter for Wipro. Both revenue and profits come in line with expectations. The IT services major says it is awaiting market regulator SEBI's note for its buyback plans. Yes Bank's first quarter profit plunges 91% to 114 crores as provisions on a year-on-year basis spike 3 times. Gross NPAs for the June quarter as well rise to more than 5% versus 3.22% in the March quarter. A lender says it is also analyzing a whistleblower complaint alleging irregularities in operations and potential conflict of interest by the former MD. You heard this first on ET Now. Top sources tell your channel that the Bimal Jalan panel recommendations include surplus transfer to the government in a phased manner over 3 to 5 years. But the committee may still be divided on the quantum. India's long wait for justice is almost over. In a few hours from now, the International Court of Justice in Netherlands will deliver its verdict in the Kulbhushan Jadhav case. Home Minister Amit Shah hints at Pan-India NRC. While addressing the Rajya Sabha, Amit Shah says the government will identify all illegal immigrants and infiltrators and deport them as per the international law. Karnataka MLAs gear up for a trust vote tomorrow. In a breather for the rebel MLAs, the Supreme Court empowers the Speaker to decide on resignations. Also says it cannot compel MLAs to attend the House. The rebels will be given the liberty to either participate in the House proceedings or skip it. Well, there you have it, a wrap of all the big news at this hour. But like I said, we are going to be talking about your money and new investment avenues as well that pop up every day, almost every day at least, on for you. And this is, of course, the Money Show where we will talk about that. Today, there's a new product that we want to talk about. Well, not exactly new, but at least a new edition of it. And you can kickstart investment in that tomorrow. Tomorrow, that is the 18th of July, is when the CPSE ETF's tranche will open. What are the advantages? What are the disadvantages? What exactly is a CPSE ETF? And should you invest in the CPSE ETF? We will be answering all of those questions and queries. And for that, we have with us, joining in right here in the studios, Kalpesh Ashar of Full Circle Consultancy. Thanks a lot, Kalpesh, for joining in. I think to start off with, Kalpesh, let's explain to our viewers what exactly is a CPSE ETF. 11 PSU stocks, and this essentially is a way for the government to say, hey, I don't want to own so much in these anymore. Here you go to the general public, you can buy this. So what exactly is a CPSE?
So basically, it's a central public sector enterprise unit, and it's now in the form of an ETF.
Yeah.
So as we know, the ETF is a passive fund, and it practically just mirrors the index. So by being a passive fund, it's basically a basket of 11 PSU stocks, like what you rightly mentioned. And when you say the 11 PSU stocks, they are probably the behemoths of the government holdings which they have. So you have all the ONGC, the NTPC, the rural electrification one, then you have the power finance. So all these companies which you see here, the Oil India, Neveli, and all this make a full basket. And the government has decided that it wants to divest. And its actual long-term plan is of almost garnering in 1 lakh crore or something. And this tranche could probably fetch them 10,000 crore or something from it. So the question now is that this ETF, which is coming out as a sixth tranche tomorrow, is on for the public. And like you rightly said, the question is, should we invest in it? So that's the $1 million question. That although it might be I would say a jackpot for the government, but is it right for the investors to get in? And just by the ETF norm, it is a very cheap product to get in. But we always, as financial planners or advisors, want to understand for an investment perspective, the underlying security.
In fact, on that note, let's pull up that underlying security, and I'm just going to request my producer as well to pull up those names again. If you look at them, they are like these Maharatnas of the government, what you call names which are so valuable with great assets. ONGC, such a cheap company at only 140 rupees, and look at the assets. NTPC, IOC, these are the Maharatnas, and you're clubbing all of this and you're offering them to the investor. I mean, wouldn't you say that? Wouldn't you say honestly, Kalpesh, that there's very little reason to not invest in them because there are such good stocks in it? Why would you say no?
See, there's a little bit of a paradox there. What I would suggest is that, people look at it as a blue chip. And in fact, all of these, many of these feature in your index funds also, But the problem is that the PSU banks, the PSU entire section which is there, constitutes mainly of all these sectors which are energy and its allies. So if you see the energy sector, the infrastructure, all those things, and we have very little of the financial sector in it. Now this is the PSU
which
unit,
has a lot of promises.
Which has a lot of promises.
So
from an investment perspective, I think there's a lot of concentration in that. So, and when we talk of investments, you talk of mutual funds, you talk of diversification, even in shares, you would like to have a little bit of, a spread have. So in this, all the things which you see, the finance one is very less. Whereas in the index, the NSE, if you see, finance is almost a big constituent, and that is the one which moves. We all track the NSE index and all those things. The blue chips also are there in that sector. So it's a bit of a paradox, like what I mentioned to you, that these names are very strong names. In fact, they are good dividend yielding companies. But as investors, we need to see the annualized returns. And sorry to say, but the returns of these companies, as an investor would look at it, have not been very pleasing.
So you know what? Let's do one thing. Let's look at how this ETF has done in the previous tranches. We have this return as well that we had calculated. What happened in the previous tranche, and since inception, how is it done? And like you're saying, there are better money making opportunities that are out there. But folks, let's talk about the tax benefit. Kalpesh, there you have it. This is the return. 3 years, 11%, and since March 2014, it's 9.8%. Not that great. This is of course a CAGR, but not that great. I mean, you have the markets as well that have actually given a better CAGR. So I guess there are better opportunities over there. However, Kalpesh, you get that tax benefit of Section 80C. Would you still say it's not worth investing, or do you think there are better tax-saving avenues as well?
I think there's a little bit of a confusion here, and I think that should be cleared. What they have done in this present budget is they have included the CPSE ETF in the 80C basket. Now, first, let's talk about the 80C basket. It's very necessary to understand that. So we as financial advisors have always been telling our investors, or in fact the government, it was on a wish list, that the 80C basket is very crowded. So you have in 1,50,000, you have almost 10 to 12 options where you can invest and get that deduction. And now this comes as a giant addition to that. And on top of it, they have linked it to an ELSS. So all the benefits of the ELSS, which were the 3-year lock-in, the shortest in the ATC family, and all those things are coming out here. So it's a plus and a minus both. So because in an earlier CPSE ETF, it was, and one more thing, Mubin, I would like to add here, that when they offer this, they offer it with a 3% discount or something to the value.
Right.
So many people who used to get into the earlier CPSEs,
Yeah.
and without a lock-in clause, they also had an option to exit.
Exit, right.
So now they are stuck with that in this particular one. So I particularly don't really fancy, on an honest note, that this should be a part of your ATC, spectrum at all in an individual.
Or then the government should just increase that 1.5 lakh limit.
Yeah.
Okay.
So that is really, that's the main thing. In fact, for ages now, I think last 4-5 years, we've been pleading that this 150 should have been expanded to 2 lakh or 2 lakh 50. But anyway, so
you've got the 5 lakh rebate. I think the government will tell us to be happy with that for
I think
some
we have
time
to live
now.
with that.
Okay. You know what? We decided that let's bring on board the manager of the Reliance CPSE ETF, and that is Reliance Nippon. So before we get on board our viewer queries, etc., listen in to the manager Vishal Jain. He's the head of ETF and fund manager with Reliance Nippon Life, who says that the divestment, of course, is a fundamental good. The company is in the long haul, as it will ease liquidity pressure.
If you look at the CPSE ETF, it's a good basket of 10 securities which are blue chip public sector companies. So Maharatnas, Navratnas and Mini Ratnas. To name a few of the companies, there is ONGC, there is Indian Oil, there is NTPC, there is Coal India. So these are the large blue chip companies which are part of the index. Now if you look at the overall valuation of public sector companies, they trade at far lower valuations as compared to the market. So if you look at the valuation of the CPSE ETF, the valuation is approximately about, it trades at about 8.5 PE or so, as compared to the Nifty, which trades at about 15 PE or so. But if you look at the return on equity, the return on equity is very similar. And to also add to that, dividend yield of these companies is substantial. So if you look at the dividend yield of these companies, that means if you look at the dividend yield of the entire CPSE basket, it is 5% as compared to just 1.25%, for the Nifty. When you look at it from a longer term perspective, I mean, increase in float in the market only leads to greater liquidity, and that many more different sets of investors coming into that particular share, or in that sense an ETF. So when you look at it from the longer term perspective, people always look at fundamentals. I think in the short term, yes, because there'll be a liquidity overhang, it could be a problem. But in the long term, I think people look at fundamentals of a company, and I think that matters the most.
Okay, so there you have it. You heard it from the fund manager himself as well on what's his strategy going to be like. Yeah. So final verdict then for retail investors, for anybody who is perhaps looking to park their money, and of course again for the longer haul, would this be a good instrument?
On an honest note, no. Because I would sincerely say that there are better options. Yeah. And now we have a very broad market. And this might be a great take for the government. But on an honest note, as an advisor, I would say that really it's not getting into just for the tax benefit because it's linked to ELSS. I think even the pure ELSS is a better option. So CPSE ETF is surely a safe play in the space. But if you want a good alpha generation, there are better options in the mutual fund space simply for its diversification.
Okay, all right. There you have it. That's Kalpesh's verdict. For now, you should consider avoiding it. Too much confusion, and also the fact that there are better names available with better return generating capacities as well. Quick break right here on the show, but Kalpesh will stay with us right here, and he is going to answer all your questions and queries. We're going to start off by taking email queries, but our phone lines are open. Quickly call in. Hi everyone, welcome back. You're watching The Money Show right here on ET Now, where we are joined by Kalpesh Asha right here in our studios. And folks, it's your golden opportunity to get your portfolio vetted by a financial planner, financial expert. The numbers appearing on the top of your screens, 24990388, or of course email us on themoneyshow@etnow.tv. For now, let's take some queries that we have received via email. And our very first question, let's pull that up on your screens. Who have we received it from? And it is from one of our regular viewers. It's Sudhanshu Mishra. He says, I've invested in a slew of funds all are direct and growth plans, and then he has given a list of all the funds that he has invested in. Mind you, it's quite a long list actually that he has sent. That will appear for you on your screens. ABSL Equity Advantage, ABSL Hybrid, small cap, liquid. So there's full ABSL, and then there's ICICI Prudential as well. There's the blue chip, debt and equity, large and mid cap, liquid and multi-asset. So essentially he split it between two funds, but he's diversified within those two funds very well, literally going from every multi-cap and even from equity to liquid. You know, it's quite a big diversification over there. All are direct and growth plans like he mentioned. So I think that's a thumbs up. Usually direct and growth plans do get the thumbs up, you know, by a lot of financial experts. But yeah, all in all, if you have to comment on his portfolio, do you think he should perhaps limit his, fund number of funds?
Yeah, so I think, as you say, thumbs up to a direct plan.
Yeah.
But it shows that he also needs advice.
Okay.
So, because you wouldn't need so many funds, schemes, I would say, in a particular portfolio, because they tend to overlap. And it's too much of just paperwork and it doesn't really add to the returns. So, I would just sincerely say that, you know, what he should be doing is fix up a goal.
Yeah.
Why is he investing? And more importantly, limit it to just 3 to 4 funds. He can have one liquid fund for a contingency. He can have a large cap fund. He already has a good large cap fund in ICICI Prudential blue chip fund. He can have a good multi cap fund, which is missing here. He could have the SBI focused equity fund. And he could also have, because if his time horizon is more, he can have a mid-cap fund in Kotak emerging equity scheme. So he'll have a spread across the market thing, and he should stick to his allocations, what he's doing. So many schemes are not required by anybody. Do not go under the illusion that if you invest in many schemes, your returns are going to hasten up. So limit your schemes to 3 to 4 and stick to your plan.
Okay, all right. Well, yes, it's a direct plan, so he may be in need of financial advice. But yes, Kalpesh has, of course, given you some advice. You should cull down some funds. There's really no need to have so many of them in your portfolio. Okay, we have a live caller joining us, Venkat from Coimbatore. Hi, Venkat. Good evening. What's your question?
Good evening. Can you hear me, please?
Yes, very clearly, Venkat. Go ahead.
Yeah. Actually, as the expert pointed out, you know, this CPSE ETF scheme may be good for the government, not for the individuals who are investing there.
Yeah.
Because you see the share value of all these stocks, you know, like BEL, it was 157 rupees last year. Then it went down to 82 rupees. Now it's slowly coming up. See NBCC. See, these stocks, my personal advice, because I also burnt my finger, that, you know, we should not knowingly take the risk. So I fully accept the views of the expert. And another thing is, you know, the dividend they're saying, I don't think CPSE ETF people get dividend. That's what I want to ask him, you know, whether we get dividend on this.
Okay, all right. I'll just get your question answered. So unfortunately, Kalpesh could not hear the question. But yes, Venkat completely agrees with your view that he too is a little circumspect on the CPSE ETF. He's talking about individual share movements as well. I think he's a very avid stock tracker, Venkat, pardon me. He's been tracking BL, etc. and what it's been doing. But he had a question on the dividend part of it. Whether this CPSE ETF, while individually these stocks are good dividend payers, but does the ETF itself do allow dividends to the investors?
No, so it's incorporated in the ETF structure itself.
Okay.
So there won't be a separate payout per se, but it is the fundamental here to be understood that these are cash-rich companies.
Right.
And if you're investing in that, obviously you're looking at a capital appreciation. So don't just look at the dividend play per se. Because although it is a good, more than the normal NSE, companies which are there. But I would look at it as capital appreciation for the long term. That is what will make you wealth, not the normal dividend payouts.
Okay, yeah. So there's not going to be any ETF dividend separately that will be rolled out.
So, yeah.
It's going to be enriched in that ETF number as well. And yeah, Venkat also said, by the way, that he too believes that this is more for the government as opposed to the retail investor. Okay, Shankar Sen from Andhra Pradesh now joins us on the phone line. Hi, Shankar. What's your question?
Good evening, madam.
Good evening, Shankar.
Madam, awareness is increasing in the middle class section and simple middle class, like myself.
Okay.
It has increased the AUM of many popular funds, like Kotak Standard Multi-Cap Fund, which is about 26,000 crores.
Okay.
Then Motilal Oswal Multi-Cap 35 Fund, it is about 14,000 crores. And Aditya Birla Sun Life Equity Fund Multi-Cap, 12,000 crores.
Okay.
Now, can the fund manager, I have been investing, my age is 36, I have been investing in this fund since last 10 months. Okay, madam. Due to this huge AUM, can the fund manager get good quality stocks to generate alpha? I am a simple middle class. I want to earn 12%, 12 to 13%.
Okay.
In the future, can the fund manager get good quality stocks in Kotak Standard Multicap 26,000 crores, Motilal Oswal Multicap 35? This is my question to sir.
Okay,
Kindly
so there is the
answer.
Kotak Multicap, Motilal Multicap and ABSL, is that right?
Aditya Birla Sun Life Equity.
Aditya Birla Sun Life. Okay, it's a very interesting question he had. Shankar says basically that obviously the popularity of mutual funds has increased. The AUMs as well as of a lot of these funds has ballooned, and how, for example, Shankar, a simple middle class man, he as well has invested in these mutual funds, the Motilal Multicap, Kotak Multicap and ABSL Multicap. Now his question is that when AUMs balloon to such an extent, to what extent can the fund manager generate an alpha? He is looking for just a 12% return approximately, but we do know what's been happening off late with mutual funds. And by the way, there's this increasing observation that many of these active funds are not being able to generate that alpha. So what is your view on that?
So first of all, Shankar is a very evolved, I think, person, because his return expectation is very, very moderate and controlled, I think. Because when you invest in equities, people tend to go overboard. Now, as far as his assessment of mutual funds goes, that and the funds he's pointed out, in fact, they are large funds. The AUM of these funds is really large. And there's always this, hanging sword on the fund manager, that if the size of the fund balloons, how will he be able to manage? Because the universe is limited. And everyone is fishing into the same type of things, But I think after the SEBI recategorization, I think it has been little bit more, I think, focused, that you have the first 100 funds in the large cap category, then 100 to 250 is the multi-cap space. So here the universe which is there now, the client has the choice as to into which category does he wish to go. And the other part here is that always look at funds which have a little bit of pedigree attached to them, and the fund manager performance also attached to it. Because it's not necessary, I'll clear a myth here, that if the size of a fund exceeds, the performance would come down. Obviously, the smaller sized funds in the small and mid cap have outperformed. But this is a problem which is faced by the large cap funds. And I'll give a simple solution here, that of late, many large cap funds have not performed.
That's true.
That is why people are looking at even moving into index funds. Because the index funds have of late, I think at least the last 1 or 2 years, have been outperforming the normal active large cap funds. But when it comes to multi-cap, small cap, mid cap, the active fund management style still remains a favorite. So you can create a portfolio in that way, that in the large cap fund, you can go in the index category. And when you want a little bit of an alpha generation, the mid and small cap funds chosen by you with a little bit of a smaller size could be your choice of funds.
And you save on costs as well, because obviously if you go for active funds, there will be a little bit of a higher cost.
Index funds have that advantage.
The high,
but then you can't keep on compromising on the cost factor also, because then you want a return, because mid and small caps over a 5 to 10 year period would have really outperformed.
Okay, so Shankar, I hope your question has been answered. Essentially, for large cap funds, just go for a passive fund. You're on an index fund. But maybe you could be a little experimental for small and mid cap funds. That's when you could go for active fund management. Completely out of time. Sorry, we'll not be able to take any more calls. Kalpesh, thank you so much for joining in. Really appreciate it. No CPSE ETFs according to Kalpesh. But I hope we've been able to answer your questions. Stay tuned to ET Now.